All right, my favorite people at the BiggerPockets community, and in today's video, we're going to go into the fundamentals of multifamily investing. I'm going to provide a 156 unit case study. So you'll definitely want to go ahead and stay into the end. All right, name is Sterling White, and those of you who are on the YouTube, you know the next steps. Hit that subscribe button as well as the notification bell. That way you can be informed when dropping these absolute bombs in golden nuggets moving forward. And if you're just now coming across myself, yes, I am bald, have to make that disclaimer. Buy and hold investor in the Midwest, recently relocated from Indianapolis to Houston, Texas. Formerly had 150 single families and then transitioned to multifamily in 2017 and scaled portfolio to just under 500 units. One thing is, not perfect by any means. I still make mistakes to this day, and I share those mistakes. Yes, it's good to learn from your own mistakes, but it's even better to learn from others. So we're going to go ahead and shift into the 4 fundamentals that you'll want to have and give you a backstory on an actual deal. So these key fundamentals are what I have learned from others who are even further along in their careers, in their journeys than I am. So it starts with buying right, financing right. So if you're bringing on debt and you're getting that from a lender. The third is buying in good to great locations. So avoiding neighborhoods where it's a lot more volatile. There's a lot of crime. There is a lot of turnover with vacancy. The schools may not be the greatest. And then the last but not least is manage right. And this was one I see most people don't mention, because you can take a good deal and through managing it inefficiently, you can turn into a bad deal, and you can take a subpar deal and through managing it efficiently can actually turn it into a good deal. So the backstory on the 156 unit apartment. So it all started with a cold call direct to the owner. Our approach has been direct to the owner because right now it's just been very competitive with on the on-market side, and would love for you all to comment below is what has been your experience with buying deals through agents or brokers. Would love to hear your experience from that. Are you overpaying? Are you underpaying? Are you getting good deals? Are you getting subpar deals? So on this is started direct to owner. Saw the property, it needed work. Parking lot looked like an alligator's back. Found out who owned the property, which it was in an LLC, which this is all public information. Anyone can find this. And then it was owned in an LLC, and use this one source, and I'll go ahead and share this source with you. That's fantastic. So you'll want to go ahead and get a pen and paper available once I share this with you. Are you ready? It is spelled Google. Yes, Google. So you can actually type an LLC into the Google search bar, and there's certain directories that you'll want to look for. Opencorporates.com, Manta, betterbusinessbureau.org is bbb.org or .com. And then you can find out who owns that LLC, whether it's a manager, member, or principal. And then you get their contact information, and then this is where you do the outreach. Our channel is calling. Some people do direct mail, text blast, email blast, whatever the case. Ours was a call. And this was over the course of a year and a half, because constantly had to keep doing digging, because this was a deal put together by the owners years ago. A syndication syndication is them pulling together funds from multiple investors to then acquire the property. So some of the people had passed. So I had to go through all these spider webs, and it took a year and a half to finally get in touch with one of the decision makers. And it came down to was they had a problem to be solved. They were motivated. And this is very key, is if someone is just wanting to sell for the right price, or you give them an offer that they can't refuse, then many of the times that's not an ideal seller. That's what we've personally experienced. Now to the underwriting phase, because you want to ensure that you are buying right, and you're going to have to make some assumptions on the front end. And this as well was a good location. This was a solid C+ to B- neighborhood by Township Schools, which Township Schools is really good. Starting with this is the underwriting. You have to know what your end goal is. what do you want to earn on your money? There's a couple metrics out there. There's what's your cash on cash, meaning is if you invest $10,000 and you earn $1,000 that first year, and that's net, that's 10% cash on cash, because that's the actual cash you have into the deal. I just kept that very simple, you guys. It can get a little complicated, but we're saying $10,000 is your cash into the deal and you earn $1,000. That's cash on cash. And then let's say in 4 years you want to sell the property and you want to look to double your money. So now you've got your end goal in mind. Now you'll underwrite deals and find deals based upon that endpoint that you want to get to, and you'll reverse engineer and say, okay, I can buy this deal based upon that. At this stage, got the T12, which is the trailing 12, the past 12 months of the income and expenses, and then also received the rent roll as well. And then that's when started the process and say, this is how it's currently performing. We put X into it to then raise the rents and also raise the value of the property. And then from there, we'll be able to get this return on investment. And then we offered on that. And this was the mistake I made, you guys. Yes, I make mistakes. So on this particular deal was myself, I underwrote it and was too aggressive on the rents, in which we would put X amount of dollars into it, because this was an older property in the 1970s built. So it needed quite a bit of work, meaning the roofs all needed to be replaced. The interiors of the units all needed to be updated. The HVACs also needed to be replaced as well. So took all these into consideration and said, we put in this amount, which on this particular property was about $2 million. We put this into it, we'll increase the rents. And I was too aggressive by $75 and then offered $7 million to the actual owner. And they accepted. From there is that ended up getting another set of eyes, the person who would actually oversee the leasing now. And they said, yeah, you're too aggressive by 75 units. I wouldn't feel comfortable with us renting at that and buying on that. So from there, this was, because you consider $75 across 156 units times 12 months, that's a huge swing in income. So now we went from the underwriting stage to now the renegotiation phase. And I'm gonna go ahead and jump into this. One, especially with these older properties, one thing to consider is whatever your estimated rehab is, increase it by 10 to 15% more. That's just a personal experience share. The percentage may be lower, the percentage may be a little bit higher, but just to expect the unexpected, because the unexpected will happen. There's some hidden things that will end up coming up and end up costing you more. So in that case is to put a buffer in more than what you believe that you'll need for the particular project. Shifting into the renegotiation, I'll give my partner on the deal, Jacob Blackett, shout out to you, is that we hopped on the phone with the owners, and this was about a 20 to 30 minute conversation. But in summary was, we were asking for a $1 million discount, and we ended the call and we felt very good. But in actuality, we provided a summary on that conversation, and we asked for a $1 million discount, and that did not get conveyed. And the owners on the other side absolutely blew up. Well, one of them in particular blew up. The other one was fine, and that was one more of who we really had a good relationship. Relationships are very key. So the other person just absolutely blew up. And in essence was, we ended up getting the reduction by about $800,000 versus the $1 million. And that's when we ended up going under contract for $6.2 million. So one, it's always key to find someone who has a problem to be solved. And that way you can provide a solution. Key things is if they're just open to offers or sell for the right price, or you give them an offer that they can't refuse, it's likely not a fit, and you'll go in and overpay, which is now you're not buying right. Second, on this particular deal, on the finance right, is ended up getting a lender involved, financing 70% of the loan to value of the purchase price, which some people may go a little bit higher than that. In those scenarios, that's where you run into over leveraging your property. And this is what I've learned from others who were during the 07, 08, 09 times, is they over leveraged their property, put too much debt, and ended up costing them at a later point. So that's the other element, is financing right. And then, as I mentioned, buying in good locations, avoiding the ones that are high crime, schools aren't the greatest, a lot of loitering that's going on, high vacancy, so buying in good locations. And then now the second half post-closing is currently what we're going through at this moment. And one of the things that we also experience is, and this was expecting the unexpected, is all the roofs need to be replaced. But a lesson learned on this particular deal was that our contractor or our project manager got multiple bids on the roofs and went with the most affordable option. But the most affordable option for the replacing the roofs, so there's 16 buildings, of which 4 are flat roofs and the remaining are pitch roofs. The most affordable option that we ended up going with actually only had the 12 pitch roofs, but he thought it included all the roofs. So there's where we ended up going over budget, but now ended up through the interior renovations is actually lower than what we expected on that. So end up now ahead of the projection. So that's, in summary, you guys, is the fundamentals, is ensuring that you're buying right, is whether you're going on market or even off market and taking the direct to owner approach, is just ensuring that you're hitting your numbers and not being too aggressive in your underwriting component and saying that, well, rents are steadily going to keep growing and cap rates are steadily going to keep compressing, which from that is that prices are still going to keep going up. Second is financing right. So not putting too much debt on your property, because that could end up costing you. Let's say something such as a crisis happens, which we've experienced that. I didn't want to say the P word because that could get this video flagged. The third is buying in good locations. Is that the other ones, let's say D properties or in D neighborhoods, yes, they do look good on paper, but actually executing on that can be very difficult. And then the last is just managing right, having a solid team that's in place, because you can take a good deal and turn it into a bad deal, or a bad deal through good management turn it into a good deal. So we'd love to hear from those. If you happen to have any other principles or fundamentals that you care to share, go ahead and comment below on that. And I don't want to forget this key point, is those of you on the YouTube, hit that subscribe button as well as the notification bell. I'll see you on the next one. Keep being awesome, you guys. All right.